Investing in the stock market can feel like navigating a maze. Fundamental analysis is your compass. It's a method to determine the true value of a company's stock. By understanding the company's financials, you gain insight. You make informed investment decisions. The goal is to find stocks priced lower than their intrinsic value. This is the core of successful investing. Before diving into numbers, grasp the company's true essence. What do they do? What makes them unique? Consider their entire business model. This explains how they generate revenue. Evaluate their key competitive advantages. What sets them apart in the market? Understand their industry position. Are they leaders or followers in their field? This context is crucial for fundamental analysis. For example, imagine a popular coffee chain. Their business model revolves around selling coffee and snacks. Their competitive advantage could be premium quality beans in a unique atmosphere. They might be the dominant player in the coffee industry. Understanding these aspects provides a solid foundation. Financial statements are a company's report card. They provide a comprehensive overview of the company's financial health and performance, much like how a report card reflects a student's academic progress. They reveal financial health and performance. By examining these documents, stakeholders can make informed decisions about the company's future. The income statement shows revenue, expenses, and profits over a period. It details how much money the company has earned, how much it has spent, and what remains as profit. Think of it like a movie's box office earnings. Just as box office numbers indicate a film's success, the income statement reveals the company's profitability. The balance sheet is a snapshot of assets, liabilities, and equity at a specific point in time. It provides a clear picture of what the company owns and owes. Imagine it as a picture of the company's possessions and debt. This helps in understanding the company's financial stability and its ability to meet obligations. The cash flow statement tracks the movement of cash. It records the inflows and outflows of cash, showing how well the company manages its cash resources. It shows how much cash is coming in and going out. This is crucial for assessing the company's liquidity and operational efficiency. This is like tracking your monthly income and expenses. Just as you need to know where your money is going, businesses need to monitor their cash flow to ensure they can cover their expenses. Let's continue with our coffee chain example. Imagine a popular coffee chain expanding its operations. Their income statement shows strong revenue growth from new store openings. This indicates that their expansion strategy is paying off. Their balance sheet reflects a healthy cash position. This means they have enough cash on hand to invest in further growth and cover any unexpected expenses. Their cash flow statement indicates positive cash flow from operations. This suggests that their core business activities are generating sufficient cash. These are all positive signs. Together, these financial statements provide a holistic view of the company's financial health, guiding stakeholders in their decision-making process. Financial ratios provide deeper insights into a company's performance. They are essential tools for investors, analysts, and managers to evaluate the financial health and operational efficiency of a business. By examining these ratios, stakeholders can make informed decisions about investments, management strategies, and potential risks. These ratios are calculated from the financial statements, which include the balance sheet, income statement, and cash flow statement. Each of these documents offers a different perspective on the company's financial status, and together they provide a comprehensive view. Profitability ratios, like the net profit margin, show how much profit a company generates for each dollar of revenue. This ratio is crucial for understanding the efficiency of a company's operations and its ability to convert sales into actual profit. Liquidity ratios, like the current ratio, measure a company's ability to meet its short-term obligations. These ratios are vital for assessing whether a company has enough assets to cover its liabilities, ensuring it can continue operations without financial strain. Leverage ratios, like the debt-to-equity ratio, indicate a company's reliance on debt financing. A higher ratio suggests more debt, which can be risky, but it can also mean the company is leveraging debt to fuel growth. Valuation ratios, like the price-to-earnings (PE) ratio, help compare the price of a stock to its earnings. This ratio is often used by investors to determine if a stock is overvalued or undervalued compared to its earnings. In our coffee chain example, a high net profit margin suggests sufficient operations. This means the company is effectively managing its costs and maximizing its revenue. leading to higher profitability. A strong current ratio indicates financial stability. It shows that the company has enough short-term assets to cover its short-term liabilities, which is a positive sign for creditors and investors. A low debt-to-equity ratio implies lower financial risk. Companies with lower debt levels are generally seen as more stable and less likely to face financial distress during economic downturns. Comparing these ratios to industry averages provides valuable context. It helps stakeholders understand how a company is performing relative to its peers, identifying strengths and areas for improvement. Section 5. The growth engine fueling future returns. Growth potential is crucial in fundamental analysis. Investors look for companies with a track record of revenue and earnings growth. Industry growth is also important. A company operating in a growing industry benefits from tailwinds. Expansion plans like opening new stores or launching new products also indicate growth potential. These factors contribute to a company's future profitability and stock price appreciation. Our coffee chain, for instance, consistently grows revenue by opening new stores and introducing new menu items. The coffee industry is also experiencing steady growth. These factors suggest a positive outlook for the company's future earnings. Section 6. Captains of the Ship Management Matters. A company's management team plays a vital role in its success. Experienced and ethical leaders can drive growth and create shareholder value. Look for a management team with a proven track record. Corporate governance is also essential. This refers to the rules and practices that guide a company's management. Good corporate governance ensures transparency, accountability, and shareholder rights. Imagine our coffee chain has a CEO known for innovation and a strong leadership team. Their commitment to ethical sourcing and sustainable practices resonates with customers. This strong management team instills confidence in investors. Section 7. Riding the wave, economic factors in focus. The overall economy significantly impacts company performance. Interest rates affect borrowing costs. Inflation influences prices and consumer spending. Economic growth stimulates business activity. Government policies, like taxes and regulations, can create opportunities or challenges. Understanding these macroeconomic factors is crucial for assessing a company's prospects. For example, low interest rates might make it easier for our coffee chain to expand by securing loans for new stores. A strong economy could lead to increased consumer spending on coffee. However, rising coffee bean prices due to inflation could impact profit margins. Section 8. Beyond numbers, the qualitative edge. While financial metrics are essential, don't overlook qualitative factors. These intangible aspects can significantly impact a company's long-term success. Brand strength fosters customer loyalty and trust. A large and loyal customer base provides a competitive advantage. Technological innovation can disrupt industries and create new opportunities. Positive social and environmental impact is increasingly important to investors. Our coffee chain benefits from a strong brand reputation for quality and customer service. Their commitment to fair trade coffee and sustainable practices resonates deeply with consumers. These qualitative factors contribute to their brand loyalty and long-term success. Section 9. Intrinsic value. Finding the true worth. Understanding the intrinsic value of a stock is crucial for making informed investment decisions. The culmination of fundamental analysis is determining a company's intrinsic value. This process involves a deep dive into the company's financial health, market position, and future growth prospects. This is the estimated true value of the stock based on its fundamentals. It goes beyond the current market price, reflecting the company's actual worth. There are various valuation models, such as discounted cash flow analysis. This model is widely used because it provides a detailed picture of a company's potential future performance. This involves forecasting future cash flows and discounting them back to their present value. By doing so, investors can estimate how much the company is worth today based on its future earnings. If the intrinsic value is higher than the current market price, the stock is considered undervalued and potentially a good investment. This discrepancy can signal a buying opportunity for savvy investors. For our coffee chain, a discounted cash flow analysis suggests that its intrinsic value is higher than its current market price. This means that the market has not yet recognized the true potential of the company. This indicates that the stock might be undervalued. Investors who recognize this can take advantage of the market's oversight. Investors using fundamental analysis would see this as a potential buying opportunity. By identifying undervalued stocks, they can make strategic investments that may yield significant returns in the future. Section 10, or conclusion: your journey to smart investing. Fundamental analysis empowers you to make informed investment decisions. By understanding a company's business, financials, and growth potential, you can identify undervalued stocks. Remember to consider management quality, economic factors, and qualitative aspects. By calculating intrinsic value, you can make sound investment choices and potentially achieve your financial goals. This journey requires patience, research, and a long-term perspective.